JPMorgan is out with a note this week saying that the odds of that happening are in fact increasing. So let's bring in the man behind that note, Joseph Lipton. He is the senior global economist with JPMorgan, and Steve Blitz. He's the chief U.S. economist with Lombard, who says the economy is reeling from the trade tensions. So I'm going to start with you, Joseph, since you put out this note here. I think we go back and forth between feeling like everything's fine to, oh my gosh, we are on the verge of having a recession. So which one is it?
Yeah, well, I think you characterized it well. There's a real tension here. In some sense, there are some fundamentals that would make you think that there's some more legs left in the expansion here. Balance sheets are generally healthy. Profit margins have come in, and that is a concern, but they're still relatively elevated. Service sector seems to be doing a lot better than what the goods producing sector is doing. So, but put all that together, and as I said, it seems like you've got a relatively healthy economy here. And then against that, you've got this trade war that just keeps getting worse and worse, ups and downs, tweets to tweets. And that's really taking a toll on business sentiment. And that's the big concern we have, which is that business sentiment has been deteriorating sharply over the past year, kind of plumbing the lows that we've seen, 7-year lows. And that's weighing on business equipment spending. So far, it hasn't fed through into the labor market in a material way, although I will point out U.S. labor market has slowed a little bit from the 220,000 pace we saw earlier. Last 3 months, more like 140 to 150,000. That's still a good reading, but it is a bit of a slowdown. So we continue to think there's going to be some resilience based on the fundamentals that I spoke of earlier. But there's these uncertainties out there that have raised recession probabilities, largely stemming from this business sentiment shock. And of course, that is coming from largely the trade war.
Yeah. Steve, this is really industrial economy, manufacturing economy versus consumer-driven economy. How concerned should we be about one side that's sputtering while the other side seems to be doing quite well?
Well, I would argue that the other side that you're talking about, the service sector side, isn't necessarily doing all that great. When you look at employment, the numbers, when you look at it without health, now healthcare basically has goes up every month. Even during the recession, went up every month. When you look at employment growth without it, it was less than 100,000 last month. So employment generally is slowing down. Also, when you look at the ISM, the new orders index for non-manufacturers, and I look at just net new orders, so it's percent up minus percent saying it's worse, and it's worse than it's been for the last 5 years.
Yeah, but the consumer's been strong. I mean, I think you'd admit that.
Well,
the sentiment numbers are high. They remain high. Everything suggests that the consumer's been strong and has been hanging in there.
Well,
it's hard to deny that.
It's hard to deny it, but, you know, the second quarter growth was a little overstated because there was a bit of an overshoot because of, you know, delayed consumption from the equity market. And that drives right to the point of recession risk, right? So the real recession risk is sitting here with the equity market and the consumer. The equity market, because households are much more overinvested in equities than in any prior cycle. And as a result, a true bear market in equities will collapse consumer spending very quickly. We saw that in December. So the Fed's job here is to keep the equity market up. And as long as the equity market stays relatively buoyant, which really means that the Fed has to confirm the cuts that the market's anticipating by actually doing them, then the consumer is going to be okay, and you get slow growth, but you avoid recession.
So, Joseph, if you think that the possibility of a recession is rising, but we're not quite at panic levels yet, what do you think is the most appropriate move for the Federal Reserve to make? We know the president thinks they should cut significantly more than what they have already.
Right. Yeah. I mean, I think the path they're on is one towards at least another cut in September, and then they'll wait and see. If we're right and there is a bit of resilience here, and that's the debatable issue, that's the conversation we're having, but if there is some resilience here, I think it would be right for the Fed to pause a little bit and wait and see, and then characterize this more as a mid-cycle adjustment. Maybe one more cut after that, but, you know, 75 is kind of what you typically see in these mid-cycle adjustments. That's the way Powell is characterizing, and, you know, that's what I would be expecting. We are looking for a September move. I think that's kind of baked in at this point, but beyond that, I think it will be much more data dependent. Obviously, if the trade war continues to escalate the way we've seen in the past week, that view could change. But right now, if you get a little bit more status quo and things steady down, one more cut seems like it would be sufficient.